One of the biggest debates in personal finance is whether real estate or stocks are better for building wealth. In 2026, both options are still powerful, but they work in completely different ways. The right choice depends on your money, mindset, risk tolerance, and long-term goals. There is no single winner, only what fits you better. Real estate basics. Real estate means buying physical property like land, houses, or apartments. The main idea is earning through rent and long-term price appreciation. It feels more real because you can see and touch the asset. Many people prefer real estate because it provides stability and predictable income if rented properly. However, it also requires large upfront capital, maintenance, taxes, and active management. Stock market basics. Stocks represent ownership in companies. When you buy stocks, you are basically owning a small part of a business. You earn through price growth and sometimes dividends. Stocks are more flexible than real estate. You can start with small amounts, buy or sell easily, and diversify across many companies. But they can also be more volatile in the short term. Capital requirement difference. One of the biggest differences is money needed to start. Real estate usually requires a large amount of capital or loans. This makes it harder for beginners to enter. Stocks, on the other hand, allow you to start with very small amounts. This makes them more accessible for most people in 2026, especially beginners who are just starting their investment journey. Liquidity advantage. Liquidity means how easily you can convert an asset into cash. Stocks are highly liquid. You can sell them quickly in most cases. Real estate is slow to sell. It can take weeks or months to find buyers and complete transactions. This makes stocks more flexible for short-term financial needs. Risk and volatility. Real estate is generally more stable in price, but still depends on location and market conditions. It doesn't fluctuate daily like stocks, which makes it feel safer for many investors. Stocks are more volatile. Prices move up and down based on news, earnings, and global events. But this volatility also creates opportunities for long-term growth if handled properly. Income generation. Real estate can generate regular rental income, which feels like passive cash flow. However, it may also come with maintenance costs, vacancies, and repairs. Stocks can also generate income through dividends, but not all stocks pay dividends. Most growth comes from price appreciation over time and effort needed. Real estate often requires more effort. Managing tenants, maintenance, and property issues can take time and energy. Stocks are much more passive. Once invested, they can be managed with minimal effort, especially if you follow long-term strategies like index investing. Long-term wealth potential. Both assets can build wealth over time. Real estate builds wealth through leverage and property appreciation. Stocks build wealth through compounding and business growth. Historically, both have performed well over long periods, but the results depend on timing, location, and discipline, which is better in 2026. In 2026, stocks are generally more accessible and flexible for beginners due to low entry cost and ease of investing. Real estate is still powerful, but requires more capital and involvement. A balanced approach often works best. Many investors use stocks for growth and liquidity, and real estate for stability and long-term security. Final reality: there is no perfect investment. The best choice depends on your financial situation and goals. Stocks offer simplicity and growth potential, while real estate offers stability and tangible value. Smart investors don't choose one blindly. They understand both and use them based on their strategy. Like and subscribe and turn on notifications for more real-world investing comparisons, personal finance education, and wealth-building strategies for 2026.